Cathie Wood stood in front of a room full of institutional investors and said something that made half of them laugh and the other half go quiet. Inflation, she said, is not coming back. It is collapsing, and before 2027, it will go negative. Most people dismissed it. Another wild prediction from the woman who called Tesla to the moon and then watched her fund drop 75% from its peak. Easy to ignore. Except the bond market did not ignore it. The 10-year Treasury yield has been falling for 3 months, even while oil prices surged over 20%. That divergence is not noise. It is the smartest money on earth quietly repositioning for a world most retail investors have not yet imagined. Today I am going to walk through the logic behind this thesis, not to sell you on it, but to stress test it. Where the data holds up, where it breaks, and what it means for your money if even half of it turns out to be right. This is not financial advice. This is how I am thinking about the next 3 to 5 years. Take what is useful, leave what is not. Chapter 1. The Jobs Mirage.
Every month, the Bureau of Labor Statistics releases 2 employment reports. Most people only see one. The establishment survey, the one that makes headlines, the one that moves markets. In April 2026, that survey reported 213,000 new jobs. Wall Street celebrated. Cable news anchors smiled. The narrative wrote itself. The American economy is firing on all cylinders.
The same month, the Household Survey, the other report, the one that rarely makes the front page, showed employment falling by 337,000. Third consecutive monthly decline, no celebration, no headlines, just silence. Why the contradiction? Because the 2 surveys are photographing different economies. The Establishment Survey counts jobs at companies with 50 or more employees. The corporate economy, the Fortune 500, the firms with HR departments and quarterly earnings calls. The Household Survey counts everyone, the Uber driver, the independent contractor, the person selling handmade jewelry on Etsy, the freelancer juggling 3-gig economy apps. 2/3 of American employment lives in this second economy, and that economy is contracting. Large corporations are still hiring, but not because business is booming. They are hiring because they are slow. Layoff processes take 6 months of legal review, severance negotiation, and reputational risk management. By the time a Fortune 500 company decides to cut, the recession is already halfway over. Small businesses cut in real time. They are the canary, and right now, the canary is not singing. There is another number hiding in the data that almost nobody is reading correctly. Average weekly hours climbed to 34.6, a 10-year high. The instinctive interpretation is demand. Companies are so busy they need workers to put in overtime. The actual interpretation is fear. Hiring a new employee means training costs, benefits, payroll taxes, and the legal exposure of eventual termination. It is cheaper and safer to squeeze 3 people into 5 people's work. Rising hours in a decelerating economy is not expansion. It is the last exhale before contraction, like a hypothermia victim feeling warm right before they lose consciousness. Wage growth tells the same story from a different angle. Average hourly earnings growth has fallen from 5.2% a year ago to 3.4% today, dropping roughly 1/10 of a point every month. The wage price spiral that Wall Street has been warning about requires a specific condition: workers with enough bargaining power to demand raises that outpace inflation, forcing companies to raise prices, forcing workers to demand more raises. That spiral needs 2 hands pushing against each other. Right now, workers are struggling to keep the jobs they have. There is one hand pushing a wall, and the wall is not moving. The economy is not hot. It is running a fever that looks like strength to anyone reading only the headline number. Underneath the suit, it is losing blood. Chapter 2. The debt panic that isn't, and the risk that is. If you spend 10 minutes on financial social media, you will encounter one of the most viral narratives in modern economics. The United States government owes over $36 trillion. The fiscal system is collapsing. The dollar is about to become wallpaper, and Treasury bonds will default any day now. It is catnip for short-form content because fear is the cheapest form of engagement. But the narrative has a problem. The data does not cooperate. In the first quarter of 2026, the U.S. federal deficit shrank by 28% year-over-year, from roughly $480 billion to $346 billion. That is not a rounding error. That is a sharp and sustained contraction. Many people assume the number must be fabricated. It is not. Behind it sits a policy most commentators either do not understand or deliberately ignore: the 2025 Accelerated Depreciation Act for manufacturing equipment. The mechanism is simple. Under the old rules, a factory that bought a $10 million AI production line would deduct $1 million per year over a decade. Under the new rules, the entire $10 million is deductible in year one. The result is a massive front-loading of tax deductions. In the short term, corporate tax revenue drops and the deficit number looks worse. But the money is not being consumed, it is being reinvested into productive capacity. Think of it as a person whose income looks bad because they spent a year's salary on an MBA that will triple their earnings. The short-term accounting is ugly. The long-term math is excellent. Government revenue lost today returns at a multiplier as those AI-equipped factories generate higher output, higher profits, and higher future tax payments. Now, the more dangerous version of the debt narrative. The United States can never truly default because it borrows in its own currency, and it can always print more dollars to service the debt. This is technically true and profoundly misleading. Printing money to pay debt is not a magic trick. It is a transfer of cost from the government's balance sheet to the purchasing power of every dollar in your pocket. The bondholder gets repaid in full. The citizen who holds those dollars watches their groceries get more expensive. It is not default in the legal sense. It is default in the economic sense. The distinction matters for bond traders. It matters less for the family buying milk. The dollar has strengthened roughly 7% over the past year, which seems to contradict the collapse narrative entirely. The short-term logic is sound. As AI-driven productivity gains accelerate and manufacturing reshores to the United States, global capital flows toward the highest risk-adjusted returns. And right now, those returns are American. More capital chasing dollar-denominated assets means more demand for dollars. The long-term picture is less tidy. Interest payments on federal debt are now consuming a historically high share of the annual budget. De-dollarization efforts, BRICS settlement experiments, bilateral currency swaps, central bank digital currencies are not replacing the dollar, but they are slowly building alternative plumbing. The near-term trajectory favors dollar strength and fiscal stabilization. The decade-long trajectory carries risks that deserve respect, not dismissal. The honest conclusion: the United States is not about to collapse under its debt. The doom narrative is intellectually lazy. But dismissing all long-term debt risk as irrelevant is equally lazy, just from the opposite direction. Chapter 3: 2 Leading Indicators. Everyone. Most people analyze inflation by watching the wrong dashboard. They track oil prices, shipping rates, grocery bills, rent indexes, all of which are symptoms. Watching symptoms to predict the disease is like staring at a thermometer to diagnose what is causing the fever. You need to look at the blood work. The first indicator is M2 money supply, the total amount of cash, checking deposits, savings accounts, and money market funds circulating in the economy. Inflation at its root is always a monetary phenomenon. Too much money chasing too few goods. When the Federal Reserve flooded the system during the pandemic, M2 surging roughly 40% in 2 years, the inevitable result arrived 18 months later: Inflation hit 9.1%, the highest in 4 decades. The Fed called it transitory. The direction was correct. The timing was wrong. They underestimated how long it takes for a monetary tidal wave to travel from the reservoir to the street. The 18-month lag between M2 and inflation is not a theory. It is an empirical pattern verified across a century of data. Money supply leads. Prices follow. The delay is mechanical. It takes time for newly created dollars to work through bank lending, consumer spending, corporate pricing decisions, and wage negotiations before they appear in the CPI print. Today, U.S. M2 year-over-year growth has fallen to 1.2%, well below the pre-pandemic norm of 3 to 5, still declining. Apply the 18-month lead. The monetary contraction that began in late 2024 will hit consumer prices in full force by the second half of 2026. By early 2027, year-over-year inflation could plausibly approach zero or cross below it. This is the same mechanical rule that correctly predicted the 2022 inflation spike, running in reverse. The second indicator is subtler but arguably more telling: the behavior of the 10-year Treasury yield. Over the past 3 months, oil prices have climbed from around $70 a barrel to $85, a 20% jump. Under normal conditions, rising energy costs push inflation expectations higher, and long-term bond yields rise in response. That is the textbook relationship, and it has held for decades. It is not holding now. The 10-year yield has fallen from 4.2% to 3.8%, a 40 basis point drop. During the same period, oil surged. Bond markets are not populated by retail day traders reacting to cable news. They are populated by pension funds, sovereign wealth funds, insurance companies, and central banks, institutions managing long-duration money that cannot afford to be wrong. These players are not pricing next month. They are pricing the next 5 to 10 years. And what they see is a deflationary productivity wave driven by AI, confirmed by a drying M2. Powerful enough to override a temporary energy price spike. When the bond market and the stock market disagree, history consistently sides with bonds. Bond investors play with money that belongs to retirees and policyholders, money that has consequences when it is lost. Their consensus is not sentiment, it is survival math. Right now, stocks are still pricing in sticky inflation and a hawkish Fed. Bonds are pricing in collapsing inflation and aggressive rate cuts. That gap between what retail fears and what institutions expect is what professionals call an expectation gap. And expectation gaps, historically, are where the largest asymmetric returns hide. Chapter 4. The most violent deflationary force in history. Every previous technological revolution replaced one category of human effort. The steam engine replaced muscle and factories. Electricity replaced candlelight and manual power transmission. The computer replaced arithmetic and clerical filing. Each one was transformative. Each one was also limited. It attacked a single layer of human labor and left the others intact. AI is different. For the first time in history, a single technology is simultaneously replacing both physical and cognitive labor, and it is doing so at a speed that is not linear but exponential. This is not an upgrade from previous revolutions. It is a category break. The most direct evidence is the collapse of AI's own cost structure. NVIDIA's H200 chip, released in late 2025, cut inference costs by roughly 70%. Compared to the prior generation. The next generation Blackwell architecture chips arriving in late 2026 are projected to cut costs by another 50%. Within a 2-year window, the cost of running an AI task will have dropped approximately 85%. A $100 task becomes a $15 task, then a $7 task. And the curve is not flattening, it is steepening. Industry projections suggest an additional 99% reduction over the following decade. This is not a discount, it is a price collapse. And unlike commodity price swings that rise and fall with cycles, this collapse is structural. Once a technology achieves a lower cost floor, it does not revert. The telegraph did not become more expensive after the telephone arrived. AI costs will continue to fall because the underlying hardware is improving on a curve that shows no sign of bending. The downstream effects are already visible, not as forecasts but as events in real companies right now. In software development, AI coding assistants handle roughly 70% of routine code generation. A single engineer augmented by AI now produces what previously required a team of 3. Development costs have dropped by 2/3 almost overnight. The outsourcing model, billing by headcount for offshore coding labor, is structurally broken. In manufacturing, humanoid robot prototypes are approaching a target cost of roughly $20,000 per unit. An American blue-collar worker earns at least $50,000 a year before benefits. The robot costs less than 6 months of human wages and operates 24 hours a day without sick leave, grievances, or wage negotiations. In customer service, AI systems now handle over 90% of routine inquiries at 1/10 the cost of a human agent. In law, AI reviews hundreds of thousands of documents and surfaces relevant precedent in seconds at roughly 1% of junior associate cost. In medical diagnostics, AI models match or exceed generalist accuracy in specific conditions, with marginal costs approaching zero. These cost reductions transmit to end prices through competitive pressure. One company in an industry adopts AI, drops prices, and gains market share. Competitors face a binary choice: match the price or lose customers. The spiral continues until the new cost floor becomes the industry standard. AI-driven deflation is not cyclical. It does not reverse when the economy recovers. The coding assistant does not become less capable next year. The robot does not demand a raise. The diagnostic model does not forget what it learned. Each year, the technology improves, costs drop further, and the deflationary pressure compounds. Deflation is not arriving as a policy decision. It is arriving as an engineering fact. And engineering facts do not negotiate. Chapter 5. Good deflation versus bad deflation. The word deflation carries a specific emotional charge for anyone who has studied economics. It triggers an automatic association. Japan, the lost decades, stagnation, despair. Prices falling, wages falling faster, consumers hoarding cash, the entire economy locked in a downward spiral. That is the deflation people fear. And that fear is justified when it applies. It does not always apply. Japan's deflation, which persisted from the early 1990s through the 2010s, was driven by demand collapse, an enormous asset bubble burst. Real estate prices fell by over 60%. The banking system was crippled by bad loans. The population began aging and shrinking, reducing the consumer base year after year. People stopped spending, not because goods were cheaper, but because they were poorer, more frightened, and surrounded by a contracting economy. Prices fell as a symptom. The disease was the evaporation of demand itself. There is another kind of deflation, and it is the dominant pattern during every major technological revolution in modern history. When the steam engine transformed textile manufacturing, the price of cloth fell by roughly 90% over 50 years. Did Britain's economy collapse? GDP multiplied tenfold. Living standards improved by a factor of 5. When electricity became commercial, the price of artificial light dropped 99% within a decade. The candle industry died, the electric utility industry, the appliance industry, and millions of new jobs were born. When computing power followed Moore's law, the cost of a unit of computation fell by 99.9% over 30 years. The computing industry did not shrink. It spawned the internet, e-commerce, cloud infrastructure, and the largest companies by market capitalization in history. The pattern is consistent. Technology drives production costs down. Lower costs translate into lower prices. Lower prices increase purchasing power. Increased purchasing power expands demand, not for the same goods, but for new goods and services that become viable only when existing ones become cheap enough to free up disposable income. Consumption does not contract, it migrates, and in migrating, it creates markets larger than the ones it left behind. This is the kind of deflation AI is engineering, not demand destruction, supply explosion. A thought experiment makes the scale tangible. Assume that over the next decade, AI reduces the average price of goods and services by 50%. Assume simultaneously that productivity gains allow average wages to double. Your purchasing power does not merely improve, it quadruples. The home, the education, the medical procedure that felt out of reach becomes accessible, and income itself has grown. Good deflation does not make people hoard cash. It makes them spend more because every dollar buys more, and the feeling of increasing wealth is the strongest consumer stimulus that exists. Inflation, by contrast, makes people feel poorer with every paycheck, tightening wallets even when nominal income rises. The question is not whether deflation is coming. The M2 data, the bond market, and the AI cost curves all point in the same direction. The question is which kind. And every piece of structural evidence points toward the productive kind, the kind that historically made civilizations richer, not poorer. Chapter 6, the part nobody wants to hear. There is a version of the AI deflation story that sounds like a fairy tale. Prices fall, wages rise, purchasing power multiplies, everyone wins. The long-term historical pattern supports it. But history also teaches something less comfortable. The long term is made up of short terms, and the short terms can be brutal. Every technological revolution that eventually created widespread prosperity first created widespread pain. The Industrial Revolution produced the Luddite uprisings, textile workers smashing machines that had made their skills obsolete, not because they were irrational, but because the new jobs had not yet materialized, and their families needed to eat that week. The transition from horse-drawn transport to automobiles destroyed an entire ecosystem of employment years before the auto industry scaled enough to absorb the displaced. The dot-com crash of 2000 wiped out trillions in value before the internet matured into the economic engine it is today. The destination was always prosperity. The road always had casualties. AI's transition may be sharper than previous ones for a specific reason. The jobs it targets first are not at the bottom of the income ladder. They are in the middle. Bookkeepers, junior lawyers, entry-level financial analysts, customer service managers, mid-level software developers, paralegals reviewing contracts. These are the roles where AI's cost advantage is most immediate. These are also the roles that form the backbone of the middle class. Displacing cognitive workers is harder to recover from than displacing manual workers. The retraining timeline is longer, the skill gap is wider, and the psychological shock is deeper, because these are people who believed education had made them immune. New jobs will come, they always do. AI trainers, prompt engineers, AI safety auditors, human-machine collaboration designers. Roles that did not exist 5 years ago. But old jobs die on a quarterly earnings cycle. New jobs emerge on a generational adoption curve. The gap between the two is where real human suffering lives. Intellectual honesty also demands naming the scenarios where the deflation thesis itself breaks. First, AI adoption could slow dramatically. Regulatory backlash, energy constraints on data centers, or corporate inertia could push productivity gains out by years, leaving inflation elevated. Second, a major geopolitical disruption, a conflict cutting off semiconductor supply or spiking energy costs, could impose supply-side inflation powerful enough to overwhelm technology-driven deflation. Third, if deflation triggers an asset price collapse severe enough to cause a wave of corporate defaults, central banks could be forced back into emergency money printing, restarting the inflationary cycle. Cathie Wood's track record adds context. Her call on Tesla was visionary. Her fund's 75% drawdown was a reminder that visionary and early are often the same thing, and the market can remain irrational longer than your portfolio can remain solvent. The responsible position. Technology-driven deflation is the base case. The structural evidence is strong, but it is not the only case. Build for the probable, hedge for the possible. That is not cowardice. That is arithmetic. Chapter 7: 5 Moves for the Transition. If even half of the deflation thesis holds, if AI compresses costs at anywhere near the rate the chip roadmaps suggest, and M2 contraction pulls inflation below 2%, then the investment playbook of the past 30 years is not just outdated, it is actively dangerous. Here are 5 repositioning moves. Each comes with a caveat, because any one offering certainty in a transition this large is selling something other than analysis. 1. Cash is half right. In a deflationary environment, cash gains purchasing power by definition. The instinct to hold cash is correct but incomplete. During every prior technology revolution, cash holders preserved purchasing power. Shareholders in the companies driving the revolution built dynasties. Textile mill owners during industrialization, General Electric shareholders during electrification, Microsoft and Apple shareholders during the computing wave. The move is a barbell. 12 to 18 months of cash reserves for defense and dislocation opportunities, with the majority allocated to productive assets representing the next wave of output growth. 2. Rotate out of cyclicals and into AI productive companies with real earnings. Steel, coal, cement, commodity chemicals. These industries profit when input prices rise. In deflation, their margins get crushed. The right side of the trade is companies using AI to cut costs faster than prices fall, expanding margins even as end market prices compress. The critical filter: real revenue, real earnings, real cash flow. Deflationary periods are ruthless to narrative-only companies. There is no inflationary tide to lift garbage alongside gold. When the water recedes, you see who has no business model. Own the companies with profits. Avoid the ones with only pitch decks. 3. Shed commercial real estate. Be cautious with residential. Real estate was the king of the inflationary era. Borrow cheap, buy property, let inflation erode the debt and inflate the asset. In deflation, the dynamic reverses. Prices fall while the mortgage stays nominal. Leverage becomes your enemy. Commercial real estate is worst positioned. Remote work has permanently altered office demand. U.S. vacancy rates have hit 22%, and many downtown properties have already lost half their value. If you hold offices or retail storefronts, the exit window is narrowing. Residential is more nuanced. People always need housing and supply remains constrained in many markets, but double-digit annual appreciation is not coming back. Own your home. Do not expect it to make you rich. 4. Allocate 5 to 10% to gold and Bitcoin as portfolio insurance. Gold has survived every monetary system collapse for 5,000 years. It is not a thesis, it is an insurance policy with the longest track record in existence. Bitcoin occupies a similar structural role. Fixed supply of 21 million, no central authority to dilute it. Institutional adoption still in early innings. Neither is a get-rich play. Both are survival tools for tail risk scenarios the base case does not cover. Enough to matter if the world breaks, not enough to damage you if it does not. Diversification is not about maximizing returns. It is about staying in the game when the dust settles. 5. Long-duration treasuries are entering a bull market. Junk bonds are entering a death zone. If inflation collapses and the Fed cuts aggressively, long-term treasury prices will rise sharply. A decline in the 10-year yield from 3.8% to 0% would produce roughly a 20% capital gain. With the full backing of the U.S. government, risk-adjusted, it is one of the cleanest trades in this transition. Junk bonds, rated below investment grade, are the opposite. In deflation, weak companies lose pricing power first. Revenue falls, margins compress, debt service becomes unsustainable, and default rates spike. The yield premium looks attractive until the issuer stops paying. Own treasuries and investment-grade corporate debt. Avoid anything rated below BBB. In deflation, credit quality is not a preference, it is a survival filter. Closing. The financial playbook of the last 30 years was built on 3 pillars: expanding debt, persistent inflation, and rising asset prices. Borrow as much as you can, buy hard assets. Wait for inflation to do the work. It was not sophisticated, and it made an enormous number of people wealthy. That playbook is expiring. The signals are already flashing: money supply contracting, bond yields falling into the face of rising oil, AI costs collapsing at a rate that dwarfs every prior technology curve, and the smartest institutional capital in the world quietly repositioning for a world of falling prices and exploding productivity. The next era will reward a different kind of thinking, not the leveraged speculator betting on prices going up, the productivity investor betting on costs going down, and owning the companies, technologies, and assets driving that compression. Every technological revolution reshuffles the wealth hierarchy. Industrialization created the factory aristocracy. Electrification created the oil and steel barons. Computing created the Silicon Valley billionaire class. AI will create its own winners, the people who understood early enough that the game had changed. But I want to end with honesty rather than conviction. Nobody predicts the future with certainty. Not Cathie Wood, not the bond market, not me. The deflation thesis is the highest probability scenario I can construct from the data. It is not the only scenario. Geopolitics can override technology. Policy errors can reverse trends. Black swans do not announce themselves. The goal is not to be right about everything. It is to be positioned on the right side of probability and to carry enough hedges that being wrong about the timing does not take you out of the game entirely. Old maps do not lead to new continents, but new continents do not come with maps either. You navigate with the best instruments available, stay alert, and keep enough reserves to survive the stretches where the instruments fail. That is not a guarantee. It is a strategy, and in a transition this large, strategy is all anyone honestly has. This video is for educational and entertainment purposes only and does not constitute investment advice. Markets carry risk. All decisions should be based on your own financial situation and risk tolerance.